Good day to everyone. This is Dr. Sivaraman of iknowindices.com. So I'll be presenting the twin webinar today, Tracking the Forex Market Together. Part 1 now and Part 2 during the US session. So Tracking the Forex Market Together Part 1 on June 25th between 5 and 45 GMT. We will track the market using the live market code page as a simple market tracking technique. In this, we will be just reviewing how exactly the market is making moves near that of the high, low, and also the net change. From time to time, we will watch it and see what sort of trading decisions we could be able to make. Besides trading decisions, we will also use the risk limiting factors like using the hedging and how exactly the hedging can be effectively used to limit the risk and maximize the profit. And I will give the live trade calls during this particular session. With the help of the live trade calls, we'll be able to find how exactly the trading decisions can be made easily without much of a stress. Now, before going to that of the market, I wanted to give you the market timings. Japanese session is between 0030 to 7:30 GMT. Then the gap time, 7 GMT, and the gap time is from 7 to 7:30 GMT. Then the European session starts by 7:30 GMT and lasts till 13 GMT. And the gap time is 13 to 13:30 GMT. US session is from 13:30 GMT to 20:30 GMT. Then there is about 4 hours gap time of 20:30 to 0030 GMT next day. Then the gap time what I am referring to, these are all the timings during which we come across a false move before the opposite move they normally do during the next session. Now let me go to that of the live market code page and review the market for your benefit. Now currently Euro is trading around 1.2316, 1.2318. The low is 1.2297. The high is 1.2342. You find a narrow range swing is happening. The net change is 15 pips negative. And in the case of GBP, yesterday it was looking very strong during the early part of the day, and during the US session they have been making up and down moves in the case of GBP from that of 1.50 to 1.4950 and just gain the levels in the case of Euro. Thereby they were able to gain the levels in the case of Euro GBP. And now Euro GBP cross is trading with about 18 pips negative net change. So they gained the levels yesterday and today they intend to drop it. Because of that, they are holding the positive net change in the case of GBP and negative net change in the case of Euro. So it is the task of the players to handle majors, and by handling the majors, they wanted to bring in the swings in the crosses, and thereby in every cross or the majors, they are able to make money, and depending upon the traders' commitments of the positions. And in the case of USD now you find that it is trading around 89.47, 89.50, 89.42 is the low, 89.69 is the high. The net change is 11 pips negative. So you find that Euro is showing negative net change and USD is showing negative net change, and because of that there is a dip in the case of Euro Yen which is showing about 32 pips negative net change. And the case of GBP, it is about 7 pips negative net change because GBP they are holding it a positive zone. And therefore yesterday you would have noticed that Euro Yen cross was dropped, and when GBP was held high, GBP Yen was not dropping. And then yesterday you would have noticed that Euro Yen was holding strong and GBP Yen they made the drop. This is how they alternate the moves in different crosses by making contrarian moves. and we need to read the contrarian moves during the market hours, then accordingly take decisions with regard to the trading. When they are making contrarian moves, that means they are handling the crosses, and we may not be able to make very good trade if we try to take positions during that of the in majors during that particular time. But if you try to take the positions in the majors during the active phase of the majors, then we could be able to see quickly the profit. So normally we should take more time in observing the market and spend less time in taking the position, closing it with a profit. And that should be the objective with which we should work in the market, rather than focusing on the other factors which are all considered by me as attributes. Then USD CHF, it is trading around 1.1017, 1.1021. The low is 1.1004, the high is 1.1046. You find about 9 negative net change is seen. When Euro is showing negative net change and USD Yen is also showing, CHF is also showing negative net change. As a result, you find Euro CHF has made the drop and it is trading near the low, and the net change is currently about 30 pips. So after the gain of the levels yesterday briefly, they again dropped it because it is weakened. So they wanted to make wild moves and hit the stops and then subsequently expose their intentional moves. So let us review how exactly they are going to make the moves by using the forecast algorithm. Before that, the commodity pairs, you find that USD CAD is showing negative net change of 3 pips, and Australian dollar is also showing negative net change of 45 pips. You can understand that they are still into contrarian move, because Canadian dollar is showing the USD weakening move and Australian dollar is showing USD strengthening move. This sort of moves are referred as contrarian moves. So let me go to that of the PowerPoint presentation and explain to you how exactly the basic trading strategy has to be decided. So what's the forex market in all 6 pairs, 4 majors and 2 commodity pairs? 30 minutes from the start of the session. But now we are around 5 GMT. So obviously it is not the start of the session, and in another 1 hour you'll come across or in another 30 minutes you will come across the closing of the session, or I mean the late session is going to start. So that time also you can just take the positions. I have given the session timing. So the session timing, Japanese session 0030 to 0700 GMT. And in that, the first 1.5 hours is the early session, the last 1.5 hours is the late session, the remaining time is the mid session. So during the mid sessions, they handle the crosses, and during the start and the end of the sessions, they handle the majors. So when you want to take positions in majors, then choose the appropriate time. So that is why I always give the timings of the market, the timings which is followed by that of the players, so that you will be able to trade along with them and earn money rather than trying to trade against them. Then if the market is near that of the high, take sell position if a pair is near high and not cut the high during the 30 minutes of watching, or take a buy position if a pair is near the low and not cut the low during the 30 minutes of watch. So we can decide upon the intraday swing trade based on the simple rule that whether the market is near that of the high or near that of the low. Currently, if you see that Euro and GBP are near that of the low, and USDN is also near that of the low. So accordingly, when they are near the low, we can take a buy position. When they are near the high, we can take a sell position, with a condition that they are not breached the high or the low in 30 minutes of your observation, or from the start of the session, 30 minutes, if they are not breached the high or the low, then we can take positions accordingly. Then it doesn't mean that our trade will be very successful, and there can be an element of risk involved in that. So obviously we have to decide the risk beforehand. So let us assume that we are taking 30 pips risk. So in that case, we will keep stop of 30 pips. And in the event, if the hedging facility is available in the trading platform, we do not want to lose any of the trade. and we wanted to earn in all the trades, then we can use the hedging order. The difference between the stop and the hedging, in the stop, once we use, the position will be closed. The original position will be closed when the stop is hit. Whereas in the hedging order, it's very similar to the stop. In the platform, it is called as entry stop. And when it is filled, we will be having a higher level buy and a lower level sell. That is the only difference. We will have two positions. And assume that a trader who has taken a sell position in the market, how he is going to behave, and another trader who has taken a buy position in the market, how he is going to behave with regard to the market volatility. The same way, we can handle both the positions separately and book profit also. Otherwise, we can, if it is hedged, we can simply keep stop at entry and close the position once the market moves in our favor. Suppose we are taking a buy position and 30 pips below the hedging is filled, then the market goes down another 50 pips or 100 pips. Then we simply keep stop at entry. Once the market goes up and fill our hedging order or close our hedging order without any loss, then it goes up. We are able to keep stop at entry in the buy position and continue to make the trade or continue to be with the trade. So that sort of advantage is available with hedging. I will explain in detail all the facilities available or all the trading strategies available when you use the hedging. So this is to limit the risk. Once the position makes 20 to 30 pips profit, we have to keep stop at entry and remove the hedging order. So there the hedging order is acting similar to the other stop. And if a stop is not hit and the position is making profit, we can keep at the same level of entry the stop. That is called entry, keeping stop at entry. Then once the position starts making profit, we will be able to trail that stop from that of the original position and keep the limit of 30, 45 or 75 pips. And the limit can be moved away from that of the market. Thereby we will be able to maximize the profit and trail the stop and see whether the position is closed with the trailing stop or with a limit. So this is how a swing trade decision has to be made as a basic trading strategy. This is the basic trading strategy. You can understand this is one of the strategies. There are other trading strategies available. I am not discussing about them. This is the prime trading strategy. Anybody who wants to initiate the trading, you should be able to see that, okay, I am willing to take certain amount of risk and entering into the market. So I will not take unlimited risk. I will just measure my risk beforehand. Then take the position. Then subsequently, when the position is going is good, then I will try to maximize the profit. When the going is no good, I will simply hedge it or I will just cut the position and accept the loss. This sort of accepting the loss when it is small and maximizing the profit are the two important elements in trading. Normal traders who enter as a beginner into the market invariably will try to allow that loss to multiply, and when the profit is seen, quickly they grab it out of the fear and they don't try to maximize the profit, and invariably they keep stop at entry and just close the position. Later on realize that the market has moved in as per their expectation. So we have to control our emotions and see that we are using the effective trading strategy and earn from the market. So for any trading strategy, there should be a guideline or there should be a guidance which is called as the forecast. So the forecast can be derived by various methods and it can be derived using the technicals or the fundamentals or the combination of that or combination of various statistical measures or using the charts, etc. Whatever be the type of forecast, then ultimately we need to see that the forecast can have an element of error. Any statistical estimation will have the permissible error. Without error, it is impossible to develop a statistical model. That is why we always estimate the standard error with regard to that of any statistical modeling. So in that process, if you happen to take position with regard to the error component, suppose the forecast is making an error of 5% or 10%, and in that particular context, you have taken a position and the position has gone wrong or the position has incurred loss, and then obviously there's no point in blaming the forecast, because the forecast is a forecast which has got the limitations. So we need to use the trading strategy and see that we are able to come out of the holding position with a profit, net profit at least. There comes the importance of the trading strategy. So we need to understand that the forecast can help us to take a decision whether we are going to do a buy and sell trade or a sell and buy trade, and whatever be that level in a given day. So yesterday we would have done a sell and buy trade in euro around 1.23 level sell and then buy it around 1.2250. And today we might be doing a buy and sell trade, buy euro around 1.23 and book profit around 1.2350. So every day you'll come across the levels will continue to vary. If you try to relate those levels with that of the previous days, invariably we will find that we are trying to buy it at a higher level or sell it at a lower level, and we find that it is justifiable. But we have to use our common sense in such context. So mine is one such forecast algorithm, and which is trying to give the forecast. So I am not giving you based on the charts and things like that. And it is a forecast, and ultimately how to derive the forecast is not important for a trader, and what is the forecast is important. So accordingly, I have given the forecast here estimated by that of the algorithm. In this session, euro and GBP are expected to make swing and firm up move. So what we have to do? We can do a buy and sell trade. Where we can buy near that of the high, buy near that of the low, and book profit near that of the high. That will be the basic trading strategy. So accordingly, we will see what sort of trades we can do now and the entry order. Now, in the case of euro, probably before going to that, let me go back, go to that of the another slide, and okay, the initial intraday highs and lows, which are set between 2:30 and 3:30 GMT, so that on all days you come across. I have been presenting Asian session webinars on all 4 days, and today is the fifth day. You find in this week how exactly the initial lows and the highs are being set. So from here you can understand they have been holding very strongly near that of 1.23 area and made a little bit of brief downward stop, and one day they had dropped it, and therefore yesterday they had dropped it up to 1.2210, but invariably they have been holding it. The high is around that of 1.23 and 1.2342 is the high now in the case of euro, and subsequently they have gone up to that of 1.2484. Yesterday they went up to 1.2385. So you find that they are breaching the highs and the lows alternate sessions, and initially they set the high and the low. So if you are doing intraday trade, like buy during that of the Japanese session and close it during that of the US session, you require a long-term forecast or the intraday forecast. Otherwise, session-wise forecast is enough for you to take a trading decision and try to book about 30-40 pips profit in your trading. Then in the case of GBP, 1.4919 is the low, which is intact. The low in the case of euro is also intact right from the start of the session, and excepting that of the Australian dollar, where they breached the low. The initial low was 0.8633 and they have formed a new low 0.8611, and subsequently they are not breached it and they are coming slowly firming it up. Now current level is 0.862124, and once it comes above that of 0.8633 and sustained there, we can take a buy position, because they have breached the initial highs and the lows, or in our observation of 30 minutes. And in the case of Canadian dollar, we find the lows and the highs are intact. Excepting Australian dollar, all the other currencies are showing the initial lows and the highs are intact. So based on that, that means for the past 5 hours, they are not breached either the high or the low. So what sort of trading decision you can do? You can use the basic trading strategy. So let me just focus the camera over the current page, the positions for the Japanese session. I will now give the levels for entry with regard to the different currency pairs, and also where exactly the entry stop has to be placed. Then subsequently, based on the going, I'll try to keep stop at entry. Then subsequently, I will trail the stop, and if the going is good, I'll try to move away the hedging limit order and maximize the profit. Or I don't keep the limit order. I just mentally decide, okay, near that of the high I'll close. When they come closer to that of the high, I'll just watch, are they breaching the high or not, or they are making a upward stop and above that of the high, that is going above that of the high, and less than 30 minutes come below that of the initial high, and I will try to watch the type of moves and accordingly close the positions. Now euro current level is 1.2318, 1.2320. The low is 1.2297. So I will try to keep a limit order 1.2299 with an entry stop of 36. I am just keeping it in case if they come closer to the low, and I will get the order filled. If it is not coming in my observation of about 20-30 minutes, then they are only dropping up to that of 1.2305 and going up, 1.2305 and going up. Then I will try to take a buy around 1.2305. So I'll just watch the live market code page in order to take the trading decision. Near that of the low, I will try to take a buy position. In the case of GBP, 1.495256 of the current level, they are near that of the high. They have breached the high just by 1/5. So I will try to buy near that of 1.4919. So keep a limit order with an entry stop of 30 pips. So I am just keeping a limit in order to assess how exactly my limit orders are exposed to the market, or are the limit orders far away from that market, or the limit orders are likely to be filled. I'll just watch for about 30 minutes maximum, and if it is not happening, I'll try to take the positions at the market. Now, when GBP, for example, it has just breached the high 1.4956, the initial high, and they breached it. And in case if they stay above that of the high for more than 30 minutes, then I will try to buy above that of the high around 1.4965 or so, and keep a stop below that of 1.4959, 30 pips below from my entry, and also it will be lower than that of my the initial high. Then I will try to keep a stop there, and once the position makes profit, I will try to keep stop at entry and maximize the profit in the buy position. And that I call it as a technical trade, but many people call it as a breakout trade. Now USD CHF, but technical trades you can only do it within the session or a maximum 2 sessions, and you cannot hold it for a long time. Whereas the basic trading strategy, if the going is good, you can hold it for a long time using a trailing stop and also moving away the limit. So there is an advantage of taking very less position and maximize the profit in each position will give the maximum yield for your investment and trading ideas. Now USD CHF 1.004 is a low, 1.1046 is a high. Currently market is around 1.101. So I'll keep a limit order so just 1 pip above that of the initial low and an entry stop of 30 pips. Then in the case of yen, the low is 89.42 and currently market is holding near that. So I will pick a limit order 89.43 with an entry stop of 30 pips. So at any given time, whatever the order I place, immediately I place the entry stop also. I don't take unlimited risk, or I don't become bullish or bearish, and I only identify whether there is a buy and sell trade opportunity available or a sell and buy trade opportunity is available. That's all. Aiming for about 30-40 pips, there is no need to become bullish and bearish, because the market is bound to make up and down moves, and market is expected to make this sort of moves to make profit for us. Either way, you should be able to do that, and they cannot continuously rise the market or continuously drop the market. You have to keep that in mind, and they have the 24 hours time frame, and this 24 hours time frame, they have to make so many moves depending upon the trader's commitment. So obviously, we cannot expect the market to make single wave moves. They will make always the swings, and when the traders have committed and they are keeping the stops, they will try to hit the stops and earn their money. So the players are in the market to earn their money. They are not worried about the economic conditions of various countries. But we only are being guided to worry about the economic conditions of various countries, forgetting the economic conditions of ourselves. Because we want to improve our economic conditions. In the process, we worry about the economic conditions of various other countries, and ultimately we fail to look after our economic conditions. Then Australian dollar, we find that 0.86238626 or the current level, 0.8611 is the low. So I will try to keep a limit order 0.8612 and see whether it is getting filled. And if they go above that of 0.8633 and stay there, I will try to take market buy position. Okay. I am just keeping it in case if they just make another dip and try to fill it. And from 1.8633, 1.8611 is just 22 pips. Normally that stop-ins are done for about 25 to 30 pips. So within that limit only they had done it. So I identified that it is a brief downward stop-in during that of the Australian session when Australia is active during trading, and subsequently they are expected to gain the levels. So that is why I am just keeping a limit order. Still, I am not taking undue risk. I will keep entry stops of 30 pips. In case if the market drops further down and fill my hedging order, I will not just like that become panic and say that my money is blocked, etc. It is very similar to that of when the stop is hit and our money is lost. So when the hedging order is hit, our money is blocked. There is a difference between when the money is blocked, we have got a chance to get back it because we have the positions to earn from that of the market. When the stop is hit, obviously we don't have any position. We have to re-enter into that market. Only then we can earn. When you continuously stop out 1 or 2 trades or 3-4 trades, then obviously you hesitate entering into the market. Whereas here, whether the position is making loss or the profit, we will have the positions, so we can review that sell position separately, buy position separately, and see how exactly we can make money from that of the market. So that should be the objective of any trader. And there are only 2 types of traders, those who do the sell and buy trades or those who do the buy and sell trades, not consistently in a given time frame. So obviously both the traders will have the stress condition as well as the greedy condition or a happy condition. And once the position makes profit, they will become relaxed and happy. Once the position starts making loss, they become tense. So obviously it is bound to be there for both the type of traders. And if we use our common sense, then we will know that, okay, near the low we can buy and near the high we can sell. And that sort of basic concept we will be able to develop it without looking into the comparing, without looking into the past data, like 1 week, 1 month, 1 year and things like that. And invariably, if you look into the data for a longer time frame, then obviously we hesitate taking the positions, or I will say that let GBP go to 1.51, then I will I will take the sell position. Or let euro go to 1.23 or 1.25 level, I'll try to take a sell position. I'm not going to do any trade, buy and sell trade, because I'm upright. Okay, fine. Then probably you may have to wait for such opportunities to come. But if you want to do intraday trade, and obviously you have to look into that of the intraday moves rather than the long term moves. Then USD CAD current level is 1.0422 and 1.0417 is the low. I'll keep the limit order 1.0418, 1 pip above that of the current low, so that I'll get a definite fill with 30 pips staging order. So you know that Canadian dollar was trading around 1.11, I mean 1.01 for a long time, 1.02 also for a long time. Now it is gaining the levels, and when Canadian dollar is gaining the levels, it might give that impression that USD is gaining it. As such, when when Canadian dollar was around 1.01 area, euro was around 1.21 area, and GBP was around 1.47 area. Now Canadian dollar is also gone up, and euro and GBP have gone up. This is how they make the contrarian move, and if you understand these things, then trading becomes easier for us. Otherwise, it might be a very difficult task. So we will continue to monitor how exactly the limits are being filled or not filled. Accordingly, we will modify. So I'll just give trade with regard to the cross, GBPN. Now 133.83 is the current level and 133.62 is the low, and net change is 18 pips positive. So I'll try to keep a buy limit order. I forgot to mention buy. So I will keep a buy limit order in the case of GBPN around 133.63, 1 pip above that of the low, and entry stop of 50 pips. So in the case of crosses, the volatility will be very high because of lesser volume when compared to the majors. So obviously we have to keep a wider edging order so that it will not get frequently hedged. And in the case of euro yen, the current low is 110.06 and current market level is 110.26. So I'll keep a buy limit order $110.07 with an entry stop of 50 pips. Then in the case of euro GBP, as I explained that yesterday they gained the level, and from there they have started dropping euro GBP, and currently net change is 19 pips and the high is 0.8264, and currently the euro GBP is near that of the low, and yesterday they gained the levels. So today I am expecting them to drop euro GBP. So I will try to keep only a sell limit order near that of the high. It is not for the intraday. It's not for the session-wise trade. Session-wise trade, we can take a buy and try to aim about 10-15 pips profit. Instead, I want to go along with it of the trend of euro GBP. They gain the levels, and you know that they gain the levels for a day and subsequently gain the levels for one more session the next day. Then afterwards, they started dropping euro GBP. If you understand the behavior of that particular currency cross, then you can easily take positions. So sell limit order 0.8264. So I'll just keep 1 pip below that with an entry stop of 50. Okay, these are all the limit orders I have mentioned. I have not taken any position at the market. I only kept the limit orders, and we will see during the course of the webinar whether these orders are getting filled. Otherwise, we will try to enter into the market. Now let me explain to you the advantages of hedging in the event the position is hedged. So our money is blocked, obviously. So we'll be really worried what we are supposed to do, whether we are going to cut the buy side or the sell side and continue the trade. There is no hurry and urgency required in handling such positions. And suppose you are trading with a position without a stop. Many of the traders have got the tendency to take a position and hold it without a stop, thinking that usable margin is adequately high. So why should we keep a stop and stop it out? And invariably, if we keep a stop, we will lose. But whether you like it or not, when the market moves against you, the usable margin will be taken away from that of the account. And in the event if the drop becomes very, very big, probably it will grab all the margin available in that of the account and you may come across margin call. So why to invite margin call just because we are not keeping a stop? So that means we are not able to understand the depth of the loss. And when you are not able to understand the depth of the loss, why you take unlimited risk of not, trading without a stop? So if the hedging facility is not available, then we should be able to keep the stop of 30 pips or 45 pips and you should not keep beyond that. If you are trying to keep a stop of 150 pips, if imagine that you wanted to keep a stop for 150 pips, many of the people try to estimate the risk reward ratio. Okay, keep 150 pips stop and the reward can be 450 pips. But if the market moves against you and hit your 150 pips stop, are you willing to accept such a big loss? You have to estimate that by yourself. And if that is the situation, why to keep 150 pips stop? Instead, wait for the market to come down. Then try to take a buy position with a lesser spread of stop. So, and that way you will be able to limit the risk and maximize the profit rather than simply or blindly go by that of the technical analysis. Then let me explain the advantages of hedging. Hedging is used instead of stop. So if you use the stop, the position is closed. If you use the hedging order, both the positions are available in the trading platform for you to continue to trade. That is the advantage. Then hedging is used to continue trade when the market moves in our favor. Suppose a position you have taken a buy position, the hedging is filled and subsequently the market comes down, then you simply keep stop at entry and wait for the market to come up, and if the hedging is closed, then keep another hedging order 30 pips below and trail it up to that of the original hedging order level so that at any given time we are taking only 30 pips. Risk, once the original position makes profit, the buy position makes profit, then keep stop at entry and remove the hedging so that you don't incur loss. Your original position also you are keeping it with certainty and it is not an uncertain position you are holding. We have got a certain plan that if the market goes against me, then I will be hedging it. If the market moves in my favor, I will just remove the hedging order and continue to trade. That sort of ideas you should be able to develop with the help of the hedging. And if that is the situation, whether the market drops or rise, you are not worried because you have got the plans for either way moves of the market. Then hedging can be used to do either way trading. If you become smarter enough by using the hedging, you will be able to understand that, okay, market means up and down moves, they will be revisiting the levels very frequently and trap the traders subsequently. So you know very well, then based on certain parameters, we enter into the market and we use the hedging strategy to limit the risk. And if the hedging is making profit, then you keep stop at entry in the hedging and trail the stop downward. Similar to that of trailing the stop on the buy side, you trail the stop on the sell side. Then keep a limit. Once the new low has not been breached for more than 30 minutes, you keep the limit near that of the low. Once it is filled, keep another hedging order 30 pips below. And once the market moves up, then trail the hedging order upward. Till such time you are able to keep stop at entry, then try to book profit on the buy side also. So either way trading opportunity is possible with the hedging. The advantage of the hedging is much more than Hedging can be used to reverse the trade when the other way going is good. In case you come across suddenly a trending move is happening in the market against your expectation, instead of an upward move, the market is continuously moving down. How you can recognize? Suppose your position is hedged, you have kept stop at entry, and all three sessions the hedging is not been filled at stop at entry. The next also it is not been filled at stop at entry. That means what? Market is going against you. At that time, you can simply close your buy position with 70 or 100 pips loss. And if your buy position is closed with 100 pips loss, then your sell hedging is already making 70 pips profit. At any given time, if the market moves in your favor another 30 pips, then you are having a break even. Even if you close the buy position with 200 pips loss, your sell position will be holding 170 pips profit. So another 30 pips drop from there is much easier. If the trending is identified, then you have a break even. If they do go down further down, you are able to make much more money than simply holding the position, and we do not know what to do with the positions. Then hedging is used to hold the position and continue trading when time permits. In the event of emergency, we can hedge and leave the trade. This is the greatest advantage of hedging. And suppose you have to attend to an emergency and you are taking a position, and if you don't have the hedging facility, you have to keep a stop and go, and all the time worrying whether the stop is filled or not. You will be looking for the code page and see whether the market has breached beyond your stop level. And once it has gone against you, then obviously you will not be able to attend to that emergency work effectively because you are incurred loss. Instead, if you use hedging, if it is hedged, fine, let the market go anywhere it wants. Then afterwards, I'll come tomorrow or day after tomorrow. After giving solution for the emergency, you can come on the third day or the fourth day and continue to trade. If you find that, okay, the trading is no good and the market has gone far away from your original position, then you can simply close the original position with the hedging, accepting 30 pips loss. So you will not have an indefinite loss similar to that of holding a position without a stop or the hedging order. Then hedging can be used to close the position at any time frame instead of stopping out the position during uncertainty. That's what I explained. That if the going is no good, you do not want to continue with the trade, you want to enter into the market fresh with a different approach, then simply close the original position with a hedge instead of stopping it out with 30 pips 2 days before. You can simply close it after realizing that it is not going to be a good trade. You can still close and still make only 30 pips loss. And you can do the other way trade, and based upon the buy position and the sell position of the hedging, you can be able to understand, okay, the hedging was continuously making profit. Let me do a sell and buy trade and earn that 30 pips or much more than that. So this is how you will be able to relate your holding position to that of the market condition and continue the trading rather than trying to look for certain triggers and also the analysis of others. Your own analysis will be the best analysis for you to get convinced and trade. Then hedging can be used to spread the risk with limited risk in each position trading. Suppose you wanted to do an averaging trading like a position trade. In every 100 pips drop, I'll take a buy, and any rise of 75 pips or 100 pips, I'll book profit. And if they drop another 100 pips down, I'll take a buy. Just sort of spread the risk. If you try to do such sort of trade, still you can use the hedging. And if you use the hedging and just close the platform and keep orders every 150 pips a buy order and 30 pips below a hedging order, and just close the platform. After about 15 days or 1 month, you just open it, you will find some of the positions will be making profit, some of the positions will be making loss. But you will not come across unlimited loss in there, and you can handle the loss making positions effectively, and you can book profit in the profit making positions. And you will see that trading becomes much more easier by spreading the risk. Then hedging can be used for breakout trade. Say for example, euro has breached 1.2342 and gone above then obviously you wanted to take a buy position, and in that case you can keep below that two hedging orders. That is one lot buy position, two lot sell positions you can keep below that of the high. In case if they make a small false breakout and then drop quickly, and your one lot buy position will be hedged, another sell position will be making profit and continue to book profit in the sell position, and afterwards take another buy position, and when they go up, you close the hedging order of the first position and close both the buy positions above their average, you get either way profit. That sort of trades can be done by using hedging. So in most of the platform, when you use hedging, there is no additional margin taken out from that of the usable margin. So that is the greatest advantage when you have got a buy position as well as sell position. If it is a 200:1 leverage, then still only $500 is taken as a margin. If it is 400:1, only $250 are taken. If it is 100:1, only $1,000 are taken. The other way position does not attract margin. But if you use two accounts as in hedging, then in both the accounts, the positions taking will attract margin. Besides, if the market makes one-sided move of an upward or a downward move for about 1000 pips, one account might be closed on margin call, another account might be having a profit, and you may not be able to book profit because you wanted to maximize it. And if the market reverses, you may lose that account also. That is what happens for most of the traders when they are holding two accounts. So the platform providers, in order to have more accounts, they will give lot of misguidance. But use your common sense to judge whether you will be able to really make such type of trade. So let us review the positions what you have taken. I mean the limit orders what you have kept and whether they are filled or not. Now currently Euro is trading around 1.2322. And still this order is not filled. GBP also the order is not filled, and USDN has gone up a little bit to 52.55. Then CHF is also not filled. Canadian dollar also not filled. So none of the orders got filled. So probably I'll just review it because I have to close the platform. Conclude the webinar and also answer the questions which are asked here. We will review it, otherwise I'll just show you how exactly I have taken the positions after about 10-15 minutes, and current market levels I'll be taking because these orders are not filled. Then subsequently I'll try to keep stop at entry once the position makes profit and show you during the US session how exactly the profit can be maximized. You can do the swing trade within the session because I am trying to take the positions towards close of the Japanese session. I will try to hold it till close of the European session and show you how exactly I am going to make money out of the trades. So let me just focus the camera to that of the over that of the live market post and take up a few questions which are asked here. There are so many questions, I don't know whether I'll be able to answer to those questions. Then B10, what do you think about gold? Gold has gone up to 1245 and is expected to drop during the day. Then sometimes players violation of 30 minutes 2 hours rule. So they don't normally violate it and they try to pretend as if they are violating. So spike for the Japanese session, yes, I am expecting the spike or the rise during the Japanese session. The spike can happen only if there is a good volume. And if there is less volume, then probably a firming up move or a rise could be seen. See, they are all the timings wherein the spike potency is there. It doesn't mean the spike has to happen. You should be able to differentiate. Forecast is giving only the expectations. The expectations can happen or it may not happen. Then, do you see Euro GBP above 1.24? Yeah, there is a great chance for them to go today above that of 1.24 or on Monday high in the case of Euro and also above 1.51 in the case of GBP. and today weekend, keep it in mind. And anytime they can make the spike, and the spike time estimated by the algorithm is during the Japanese and the US session. So watch for such moves. If it doesn't happen, don't blame me, because it all depends upon the volume the players try to make the moves. And see, yesterday the levels of gold were supposed to be 1,200, but the market went other way. What is the outlook for today? Obviously, when traders after the drop try to sell, the players gain the levels and induce them to do the short covering, because it is easy for them when the traders sell during the drop. When the traders sell during the drop instead of buying, then obviously the players have to buy those sells. And after buying it, do you think that they will drop it? They will gain the levels and induce the traders to do the short covering. Then afterwards they drop it. So this is a normal activity. There is no question of outlook and things like that. This is how they bring in the swings in the market. So during the rise, if you try to sell, then you will be able to see the profit once they stop cutting the high. And instead, after the drop, if you develop the tendency of selling, then obviously you will get trapped. So the players have got a definite trick of trapping the traders, and the traders become victim again and again without understanding it. So what can I do for that? Indeed, yesterday you were expecting spike in European session, and today in the Japanese and the US session. So yesterday was not the spike. Yes, yesterday the spike has not happened distinctly, but only in the case of Euro, a good amount of gain was seen during that US session. So they are all the potency spike times, and if it does not happen, what can I do for that? So I can only estimate and say. And if you do not want me to talk about it, fine. I can keep refrain giving that information that these are all the spike times. Because you expect, without doing any hard work, somebody to work for you. No, only the predators behave like that. The predators, no, they will expect other animals to feed and become big and things like that, and they pounce on them and feed without doing much of a hard work. And you have to do your own homework, and who else can do it for you? And if you are hungry, obviously you have to eat, and you cannot expect somebody to eat. If you want to really make money from that other market, think about the market effectively and try to develop strategies. Then rougher, or the initial highs and the lows from the first 30-minute session. What session? European? Yeah, any session start, if you wait for 30 minutes, and now Japanese session is already over, you wait for the European session, wait for 30 minutes from there, then try to initiate the buy or the sell trade. And Eric, when you are talking only with one mini lot and the hedge is filled, say a buy and the sell, for example, the sell hedge is filled and have stopped at entry. Do you ever make profit on hedge since you have only one mini lot and wait for the buy to make profit? I explained various strategies. If the usable margin is less than $30,000, try to do only mini lot trades, because the players are waiting to trap the overtraders. So those who are taking huge positions, and if they make a move of 100 pips away from you, all the positions will be making loss and the margin will be taken out by all the positions. And invariably you come across a drawdown of 50%, 70%, etc. Then you become panic. Why to invite trouble? Instead, you take only one mini lot at a time. When the going is good, you keep stop at entry and take another mini lot. So at any given time, you are taking risk only in one mini lot. You have to develop the trading idea. And if the going is good in the second mini lot, then keep stop at entry, and probably you can commit 2 mini lots and taking risk for 2 mini lots, because in the first 2 mini lots, you are already having profit. In case if the third 2 mini lots, if they are going to make loss, then the first 2 positions will make the profit and you will have no profit, no loss condition. So you have to bring the trading to a risk-free condition to start with. It is not that simply becoming addicted to trading and trying to take over positions and later on suffer and ask people here and there, ask so many questions and find out how exactly, because no analyst can move the market. Analyst can say the market can come down or market can go up. Nobody will be able to move it excepting the players. So when you ask so many analysts and some of the analysts say that okay, market is going up and market might go up, like when I say that if you wait it will go up, immediately you just find that okay, I am supporting your idea and you just hold the position without any strategy, without keeping stop, without hedging. Then when the market goes against, then immediately you start yelling at the analyst. What the analyst can do? The analyst can only give you that ideas. What could be the possible moves in the market? It can be wrong. It can go wrong. Nobody will be 100% perfect. And we are not gods. So we have to use your own strategy to limit the risk. And you should not lose the person later on, blame others. By that, do you gain anything? So you have to understand all those information. Whatever the decision you are taking, you have to hold responsibility for that. People can give both ideas, and definitely in the market you will come across a person recommending do a sell and buy trade, another person recommending do a buy and sell trade. That is bound to happen. Only then the transactions can happen in the market. Only then somebody will feel like buying at a current level 1.2317 in the case of euro, and somebody else will be interested to sell at that level. Only then the transaction can happen. If all wanted to buy, then who is going to sell? So you have to understand that how exactly the herd of people are reacting in the market, and we are trying to estimate it by using various types of mechanisms, and we have evolved it. And why we have evolved it? Because we have found that we wanted to understand market. So in the same way, you should also deploy your mind and try to find out how exactly you can make an effective trading strategy. You can gather ideas from others. It doesn't mean that you have to follow that fully. And you can always watch it and try to develop your own ideas, your own methodologies. Because your usable margin is unique for you. Your time of trading is unique for you. Somebody might be doing the trade sitting in Europe only during the European session. Somebody might be sitting in US doing only trades during Japanese session. It all after the office hours. So it all depends upon the convenience of the trader. And some might be doing a stressful trade of watching all the three sessions, taking very less sleep and do stressful trades, etc. But you have to develop the idea of doing the trades at ease, because it is a money earning process. In the money earning process, if you are impulsive, you are bound to lose money, because the players try to attract such traders to commit wrongly. Then how did you decide on your entry level? I just explained the decision that near that of the low we will try to take a buy position, near that of the high we will try to take a sell position. If the high or the low are not breached in 30 minutes of watch, then great. How much of percentage profit you make at least in such techniques? See, I consistently make profit. I do not want to give a wrong commitment or exaggerated commitment and things like that. I try to earn in 95% of the trades. And there are some trades I accept loss and grow. How are you sure that they will revisit the low and not go below? Yeah. See, if you happen to attend to that Asian session live market analysis, I have been explaining about the initial highs and the lows, how they try to breach the high and the low and things like that, create the panicness in the market. And there is no need that they need to respect the pivot points, respect the supports and the resistance. They will make the market appear as if it is respecting all and suddenly reverse. So we need to follow the moves to decide on the trades. So I developed the forecast algorithm with which I'm expecting the market to go up. Then besides, I had done the market reading in which I explained to you earlier that they accumulated lower level buy position. The players drop euro to 1.18 area and subsequently accumulate all the sells of the traders long liquidations as fresh sells. and they are holding around 1.23. When you look into 1.38, 1.27, obviously 1.23 looks like bearish. But when you look into 1.18, 1.23 looks like bullish. So they are all relative levels. But ultimately what you have to see is the players have accumulated the buy positions at the lower level, and they wanted to gain the levels using good opportunities and try to book profit with regard to the lower level buys. So they have got a strategy. We need to understand their strategy in order to make effective trading. Indeed, you always post don't be bullish and bearish, but you are giving the calls favoring the rise, right? Okay. When I use the word rise, immediately you think that it is an unlimited rise. Say for example, GBP was around 1.4950 and it has come to 1.4971. It's about 20 pips rise. So market means there will be a rise and the drop. And simply I am using the rise, and you imagine about 1000 pips rise and you start commenting about me. What word I have to use? You tell me, I will do it. So it all depends upon how you are perceiving the market. And you perceive a 20 pips rise in a bigger chart and think that it is a spike. Your own relative terminology. According to the market, if there is a rise of 150 pips, only then it is referred as a spike. That should happen in less than 2 hours. So each one will have different qualitative terminologies in order to describe the pick variations. And you have to identify how exactly it is to be used. Simply blaming others, you don't gain anything. Let me tell you very honestly. You can continue to blame. There is no problem, but you are wasting your energy. And what is your focus for GBP? I am expecting GBP and Euro to rise during the day. There will be swings. There will be misguiding moves in the market. That is inevitable. Then grow. When you will cut off your positions, will it be before the end of this Japanese session, or will you let it go during the Euro session? Still my orders are not filled, so I got only a limit, and I'll just see whether I can enter into the market. And already the market has moved, then I know that market keeps giving opportunities. I look for the next opportunities during the European session and enter into that other market. And I don't simply jump into the market. There comes the emotions that you should avoid. Okay, I kept a buy order at 1.2298. Then if it is around that, about 10-15 pips, then I can take a buy. If it has gone about 40-50 pips, I will not jump into it. I'll look for a next opportunity. How can the market continuously rise one-sided? Obviously, it has to make swings every session or during the gap time. So I'll look for the next opportunity to enter into the market. Then, Eric, what happened when hedging is filled and immediately goes the other way? So when the position is hedged, you have to watch for 10 to 30 minutes. And initially, if you are using hedging, you wait for 30 minutes and then take a decision. And during the course of handling hedging in a demo trading platform, you should be able to judge whether the hedging is filled during stop end or during a opposite trend of the market. In 10 minutes, you should be able to judge it if you watch the trade carefully and only use the live market code page as your trading tool. If you get diverted and you don't focus on your trade and you do not know how the hedging is making profit and loss, or you become impulsive when it makes 5 pips loss, immediately cut it, and later on it shows that you could have kept stop at entry. This sort of uncertainty you should be able to eliminate from the mind. Then you will make definite trades. Then if the hedging is making loss, accept the loss in 30 minutes time frame. Then keep another hedging order to limit the risk 30 pips below and trade it up. Then grow. Do you say that the majors are focused during the first 2 hours and the last 2 hours? Yes. Okay. Then grow. We in the daylight saving time. See, irrespective of the daylight saving time, sir, if you follow the GMT, there is no daylight saving system in GMT. The market is 24 hours. Then obviously you have to use the daylight and you have to use the GMT time frame rather than your local times. Don't expect the market to come to your time zone. Instead, you go to the market with the time zone in which it is being operated. Because the players have to operate 24 hours sitting in different parts of the world. So they follow the GMT time, and that is for their GMT time I have given it as a timing like 0030 to 0700 GMT and 7:30 to 13 GMT European session. Then 13:30 to 20:30 GMT is the US session. So anywhere you are, you simply open the live market page, you come across that GMT time, you refer it to your local time, you are able to understand, okay, where the market is. You try to track the market using the GMT time, you will find that the continuity of the market you will be able to perceive. Because the market is continuous. Only you enter into the market during different time zones, but the market continuously swing around. So try to adapt yourself to that of the market timings rather than expecting the market to come to your time zone. This is a wrong approach. So it is something like, suppose from India, I am trying to give a call to a person who is in US. So my time currently is around 11 a.m. in the morning. If I think that, okay, this is my right time to give a call, the person will be sleeping in US. So I have to identify whether he will be in a mood to talk to me or whether it is a daytime for him to talk or whether he is awake. So I have to identify those things. Only then I can give a call from here because that is how the time differentials are in different parts of the world. So when you are watching the market and see when the market is going to be active and focus on those times, then refer the first six crosses you have placed but limit even when the dollar is in the base or the second currency wise. No, as far as the majors and the crosses, you should be able to differentiate them. Wherever the currency is traded against the major, they are all the major currencies, especially Euro, GBP, Yen and CHF. Then the two currencies which are also traded against USD like Canadian dollar and Australian dollar, they are commonly referred as commodity pairs. Then among the currencies, if they are trading as a cross and the ratio between those currencies are being traded, and that is referred as a cross. There could be an European cross and the Japanese yen cross. These are all the two prominent crosses. So, irrespective of the majors of the crosses, you can always take the position, buy near that as a low, sell near that as a high, if the low and the high are not breached. Then, do you see yen rising above 91? Yes, I expect it to go up. And they will do a little bit of consolidation, induce the traders to lose the patience and then subsequently make the moves. Anandraj, please show the timings again. And this webinar is being recorded. So if you just listen back to this webinar, you will be able to get those timings. I'll make a quick rush of the slides now. What are the slides I have shown it? The basic trading strategy, the timings of the market. Probably you can take a screenshot and later on copy it in a Paint or something like that. Then the basic trading strategy, I explained it here. Then the forecast for this particular session, swing and permanent or expected move. Then these are all the limit orders I have made. Still none of them got filled. So let me review and try to take the market if they are close by. Otherwise, I will not take the position. I will look for the European session open and watch for 30 minutes and subsequently take the position and try to close. And I will explain it during the US session how exactly. These are all the advantages of hedging. Those who are familiar with the hedging or those who intend to use hedging can try to do it in a demo trading platform and see how exactly it is helpful. And don't think that if you use hedging, you do not know how to trade. And this is how the platform providers misguide the traders, and don't trust them because they wanted to earn money from their own clients. And we'll come back by 14 GMT and take the US session calls and see how exactly we are able to make, how exactly we have made the money or lost money with regard to the Japanese session calls, and also review all those markets in relation to that of the initial highs and the lows, and try to take the positions for the US session and see how exactly we are able to make profit. So profit is the only objective of the players. So traders should also keep the profit as the main objective, and we need not bother about other economic conditions. So we'll meet again by 14 GMT. Thank you for your patient listening. I'll come back by 14 GMT and continue the talk. See you all. Bye.